Welcome to the podcast that will teach you how to successfully invest in and build steady streams of passive income from the highly lucrative niche of mobile home park investing. Veteran real estate investors Kevin Bupp and Charles Dehart from Mobile Home Park Academy will personally share with you the valuable lessons they've learned along their journey as mobile home park investors, so that you too can learn how to build massive cash flow and huge profits from this extremely lucrative niche. So without further ado, let's welcome your hosts for today's show, Kevin Bupp and Charles Dehart.
Welcome, guys and gals, to the Mobile Home Park Investing Weekly Podcast, where we'll provide all the information that you need to know to successfully locate, negotiate, close on, and make huge profits from the lucrative niche of mobile home park investing. I'm your host, Kevin Bupp, and in today's show, we're going to be speaking with manufactured housing finance expert, Jerry Muir. Jerry holds the position of Managing Director at Greystone, working with the agency lending team. Now, prior to joining Greystone, Jerry was a 25-year veteran of Fannie Mae. Jerry's primary focus as a part of the Greystone team will be on building out and expanding their manufactured housing lending platform. Now, during Jerry's time as a Director of Multifamily Credit and Underwriting at Fannie Mae, he was responsible for a 12-state Southeast region with a dual role in having developed and managed the manufactured housing community lending platform. Now, Jerry managed the MHC platform at Fannie for over 15 years, overseeing over $10 billion in financing for this asset class. And guys, so I'm very excited to have a candid conversation with Jerry about a variety of industry-related topics. But before we do, I just have a few quick housekeeping items I want to run through with you. First and foremost, as you guys know, we're in acquisition mode over here at Sunrise Capital Investors. We always are. I don't mention this every week, but I forget a lot of times. But in any event, we're out there. We're looking for opportunities. And so while you're out there in your hunt and you run across an opportunity that doesn't fit your criteria, or maybe it's just a little too big, or you don't have the capital necessary to take it down, please think of us. You can reach out to us through our website, sunrisecapitalinvestors.com. Just go to the Contact Us page and just drop me a line. It will come to someone here on our team. They'll make sure it gets to me. Tell me a little bit more about yourself and about the opportunity, and we'll look to connect with you. Next up, we just opened up the second tranche in our Mobile Home Park Growth and Income Fund. And so if you're an accredited investor and you're interested in partnering with us on our own acquisitions, please visit our secure investor portal by going to invest.sunrisecapitalinvestors.com. And there you can review our PPM and investment summary, and also some prior webinars that we've done as well. And then lastly, guys, if you happen to be in the Tampa Bay area, whether it be for work or pleasure, I'd love to connect with you. I've connected with hundreds of you over the last couple of years. If you've got some time during your visit here, we're only about a 20-minute drive across the bay from the Tampa International Airport is where our office is located. I'd love to grab breakfast or lunch or dinner or coffee, beer, whatever it might be, whatever you have time for. Reach out to me again through our website, sunrisecapitalinvestors.com, the Contact Us page, and let me know when you're coming, and let's see if we can coordinate our schedules together. With that, guys, I'm excited to get on to the show with Jerry here. So let's welcome Jerry Muir to the show. Jerry, how you doing today, my friend?
Just fine. Thanks for that introduction, Kevin.
Yes. So thank you for joining us here. I'm very, very excited to get you here on the show. I mean, just the depth of your experience in the MHC space is second to none. You know, this is a fairly young industry when you compare it to all the other asset classes that are out there, all the different flavors of commercial real estate. MHC is fairly young. I don't know the true age, but probably somewhere in like the 80 year range or so. And so it's fairly young in comparison to a lot of the others. And you've been in it for, 25 plus years now. And so a ton of experience. And I'm excited to dig deep and understand your background, especially as it pertains to Fannie Mae. And so with that, maybe we can start off, Jerry. I think it would be appropriate I gave you an introduction. It surely wasn't expansive enough to really, for our folks to understand your background and kind of, how you came into this space and your depth of experience. So tell us a little more about yourself,
Sure.
if you would.
Sure. As you mentioned, I've been at Fannie Mae for about 25 years before joining Greystone. And it's kind of interesting. In 2000, I got a call from our home office. I was in the Atlanta office from one of the VPs who had been with the Co-op Bank, and they had been making loans on manufactured housing communities. And the VP said, I want you to go ahead and set up a program for Fannie Mae. Well, to be perfectly honest with you, I knew nothing about the product. So I called a number of lenders that were making loans on manufactured housing communities, and they sent me their underwriting guidelines, et cetera. And we put together based on that information and in my discussions with him, we put together a term sheet, and we ran it by Fannie Mae's credit committee, not just the multifamily credit committee, but the corporate credit committee. And they were kind of going, "You want to do what?" And the reason they took that reaction was they had been buying, on the single family side, they had been buying Conseco bonds that were backed by the chattel loans on the homes. And they didn't do well at all, as everybody is pretty much aware. So we went back to the drawing table and did a white paper on the whole industry and went back in again. And they said, "Okay, we'll let you set up a pilot, but you can only do the best of the best." And so the first deal we did was with Chateau Properties, and it was a credit facility with 5 real high quality loans. And the program just kind of took off from there. And they gave me a lot of latitude. And talking with the Dutch originators as we went along, they kind of helped guide me as to, hey, guess what? Most of these parks don't have public water and sewer. You're out in a little bit more rural area, and you've got well water and a private treatment plant. Because originally our guidelines had public utilities only. And we got comfortable with that. And I just kept working the program. And part of what helped me to work the program to do a more wider variety of deals and a little bit lower our quality requirements. Fannie Mae still had high quality requirements in general, but we were able to lower them considerably over time because the product performed so well. It was actually one of the best performing products in Fannie Mae's portfolio. So rewind or go forward to today. And Fannie Mae actually does they've got a quality rating system, and they do quality 3, 4, and 5. Of course, 5 are your age restricted, real high quality communities, which really are a lifestyle decision, full amenity packages, etc. And then your 3s are your family communities, which are truly affordable housing. And there's a lot of subjectivity on whether it's a 3 or a 2. And it's a pretty broad path from that standpoint. And there's certain criteria they look at. And Kevin, as you know, when you walk on one of these properties, you can tell right away if the rules and regulations are being enforced and if it's a quality deal. You might not have the prettiest homes in there, but if it's a well-run community and stable, it's going to do well. And from that standpoint, what they look for, they want paved roads. They prefer 2 off-street parking, paved spots, the homes to be skirted. But at the same time, they realize that there may be 1 or 2 older homes in the community. People have been there forever. And, when they turn over those homes, they'll upgrade them or whatever, and they don't quite meet the quality standards. But overall, the park is well run, it's clean, et cetera, from that standpoint. Another area that, go ahead.
I was going to ask if there's situations, regarding the subjectivity of, is it a 2 or 3 star? Are there certain situations with Fannie where they'll make considerations, and let's say it's by their standards, it's a 2.5 star today, but, with X, Y, and Z improvements, immediately following closing, with some money in reserves, that it can easily be a 3 star. How do they feel about that?
Well, I was at Fannie Mae. We did deals, and I'm doing them today too, where you go through and it's a quality park, but oh my gosh, there's a few homes with exposed hitches, but that's not a problem, and they'll go with that, if there's just a few homes. But again, it's the overall quality of the park, and it's being well run, and the rules and regulations are being enforced. They'll get comfortable with that. But as you mentioned, at the same time, if there's a lot more exposed hitches, or there's some skirting that needs repairs, you can set up a replacement or a capital reserve fund to make those repairs after the loan closed. So yes, that is a possibility. They will look at that type of situation.
Got it. And so give us some statistics on how, Fannie's origination volume has really grown over the years from when you first introduced that first loan to them or opportunity to them to today. I mean, and I feel like it's been leaps and bounds probably over the last 5 years. Like it's just like it's on this massive upward trajectory. But can you give us an idea from a general standpoint of pure loan volume size?
Yeah, the first few years of the program, And to be perfectly honest with you, when we first had the program, we were only doing credit facilities, and it wasn't available for the full DUS program. Now it's available for the full DUS program. You can get all the loan terms that are available to multifamily DUS from that standpoint. So we were only doing, those first couple of years, $200, $300 million worth. Well, it grew. I think about 5 or 6 years into the program, we hit $1 billion. And some of that was a result of doing credit facilities, which are larger transactions where you got multiple properties. And it grew from there. And some of the best years, we were doing $3 or $4 billion at Fannie Mae. And as you mentioned in the introduction, while I was there, we did north of 10 billion, to be perfectly honest with you. And the program continues to be one of the big programs over there. And as you know, the agencies went into conservatorship. Gosh, it's been a long time now. I think it's going on 10 years or close from that standpoint. And Fannie Mae got their manufactured housing community program in place before they went into conservatorship. But after the agencies went into conservatorship, they couldn't set up new programs. So Freddie Mac is now in the doing manufactured housing communities, but they got held out of the setting up a program for a number of years. I think they're probably going on 4, maybe they're in their 5th year of doing manufactured housing communities. So that Fannie Mae and Freddie Mac both offer that option now.
What are some of the bigger differences between Fannie and Freddie? We've done Fannie loans, but we have not done any Freddie loans. And so just from a high level point, what are some of the bigger differences between the two?
Really, there's not that much difference. It was kind of interesting when they came out with their program. I was looking at their criteria. And of course, they had to get approval from the regulator, and their regulator knew Fannie had a program that was working, it was performing well, and they probably guided them a little bit from the standpoint to look at the Fannie Mae guidelines and pretty much track them. So there's not that big a difference. The one big difference is that Fannie Mae has a small loan program where it used to be a small loan was $3 million, and then you could go up to $5 million in high-profile markets. And that's a much more streamlined underwriting, so it's much more appealing to a borrower as far as cost. And Fannie Mae has that program, and Freddie Mac has a small balance loan program, but they currently don't do manufactured housing communities under that program. And what's interesting is, it's in the last month or so, Fannie Mae actually increased the loan size for their small loan program on a national basis up to $6 million, which really helps again, because as you know, you're underwriting pad rent, which isn't typically a lot of rent, so your loans tend to be a little bit smaller in this space. And so that $6 million is really going to help some of these borrowers as far as the cost of having their loan originated.
And in that small loan balance program, what's the minimum loan size that Fannie will consider?
They'll go down to $1 million. The economics get a little tough from that standpoint sometimes because you do have some third-party costs. And from that standpoint, but they'll go down to $1 million. And then, you might have that situation where they're doing something with a particular customer. They've done a lot of business with them, and they happen to have a deal that's a little bit under $1 million. They'll probably consider that just because it's a repeat customer and they've done a lot of business with them.
I think one of the big concerns with getting into any, whether it be a Fannie, Freddie, or even a CMBS secured type loan is, in this industry, it's quite common to run across communities that have been maybe operated by the original mom and pop for many years, and maybe the full value has not been realized. Maybe the rents are drastically below market. Maybe the operational expenses are much higher than standard. But in any event, there's a lot of value that can be seen there in a very short period of time. And I know that, obviously the defeasance or the cost of getting out of one of these loans prior to the 10-year term is quite expensive. But Fannie's got a supplemental loan program that essentially might allow a borrower to tack on a secondary loan and realize some of that sweat equity that they've created over whatever period of time it might be. So can you speak to that supplemental loan program and just so we have a better understanding what that is and what the opportunity might present?
Yeah, it sounds like you're talking about two scenarios. One is where somebody comes in and buys a mom and pop where the rents are below market and they've got the opportunity to increase rents, but Fannie Mae can only and Fannie Mae and Freddie Mac can only pretty much underwrite to what is in place at that time.
That's correct.
And so the new owner comes in, and as you know, typically rent increases are on an annual basis. And so that, let's say they bought the property in January, their annual rent increases in July, and they're going to raise the rents considerably. With Fannie Mae, you can typically get a waiver because usually they don't want to put a supplemental loan on until after 12 months. Mm-hmm. Because it's typically where's all this appreciation coming from? And it's kind of like, well, from that standpoint. But on manufactured housing communities, because you've got so much stability, because it costs so much for a resident to take his home and move it to another park. I mean, it could be in excess of $7,000. They're not going to just move down the road like in a multifamily property where the property down the street lowers their rent and residents go, I think I'll move down there. And it's not that big a deal. You got a lot of stability in manufactured housing communities. So they'll sometimes give a waiver to allow a supplemental within 12 months based on that rent increase. And then that rent increase, just compared to how they underwrite multifamily, they underwrite to the trailing 3 months revenue. Typically, they annualize that. Mm-hmm. On a manufactured housing community, again, because of the stability, as long as that 1 month rent increase is in place and has been collected, they'll underwrite to that higher amount. Mm-hmm. And then the other situation I think you're talking about is where an owner, there's a loan in place with an owner and he's raised the rent, and you can get a supplemental loan again based on the increase in the rents, and they'll underwrite to the trailing 1 month rent increase.
What does that supplemental loan look like? What's the combined loan to value, and also what does the process look like to obtain the supplemental?
Well, they actually call it first lien pricing, so you get an advantage there. But again, you got to meld the two rates from that standpoint. As far as the underwriting, I mean, it's basically a second mortgage, and so they're underwriting that in. They have to re-underwrite the deal, but they'll go up to 75% of the appraised value. And then, your debt service coverage has to play out. Fannie Mae has risk-based pricing. Mm-hmm. They've got what they call Tier 2, which is 80% with a 125 coverage. Tier 3 is 65% leverage with a 135 coverage. And then your Tier 4 is 55% LTV, 155 coverage. And you get better pricing the more conservative the loan is from that standpoint. And so, if you got a Tier 2 loan on the property and you want to do a supplemental, you would get Tier 2 pricing on the supplemental, basically.
Okay, fantastic. And
but a max is 75% LTV at that point.
Okay. And what do you see? I mean, in the foreseeable future, I mean, would you say that Fannie, would you classify them as being bullish in the MHC space, or do you see things changing a little bit? I mean, the whole talk of recession, I mean, has been getting thrown around for the last couple of years now, right? No one's got a crystal ball, so no one has any idea. And I think that we are in the right space. When the tide turns the opposite direction, I believe that the MHC space is the most stable housing option out there, at least from an investor's perspective. But I mean, as far as their lending criteria, do you see them still being very bullish in this industry?
Most definitely. Their regulator, the FHFA, basically restricts the amount of business the two agencies can do, and they call it capped or on-capped business. And on-capped business is they can do as many loans as they want in that space, and they consider manufactured housing community lending on-capped business. And actually, Fannie Mae prices it a little bit better than multifamily in certain cases. From that standpoint, again, their portfolio has performed extremely well. They love the business. And then you've got the situation where, I don't know if you're aware of a program or the regulator calls it duty to serve, where the agencies have to play in the affordable housing preservation space, rural housing, and they added manufactured housing communities to that space. On the single family side of the business, under this duty to serve, they've asked the agencies to look at chattel lending, which could be a really big plus for the industry. As you know, and I think you mentioned it earlier, that there's more rental housing in communities because there's chattel lending out there, but it's not that available in certain situations. So a number of borrowers and park owners have turned to park-owned homes and renting them out. And sometimes they do a lease to purchase, but Fannie Mae considers that the same thing as a rental, to be perfectly honest. Mm-hmm. So if the agencies came out with chattel lending, that could really help, and it would probably be more affordable than current chattel lending, and it would really help communities to fill up their spaces. But
where are they at with that program? Are they actually in a pilot program at this point in time? Or I've heard word of it, but I wasn't really sure where they're currently at with it.
They haven't, and I haven't seen it yet. But the last meeting, I actually serve on Fannie Mae's Duty to Serve Council, and they haven't come out with a pilot yet. The biggest problem they're having is getting industry data on performance, mm-hmm. and they've asked the lenders that are in that business to help them get that data. And so they, I wouldn't be surprised maybe later this year or early next year that they'll probably come out with a pilot on chattel lending, and go from there.
I'm assuming the other lenders in the space are probably keeping it close to the vest. I mean, you talk about a big competitor coming in. Warren Buffett's
that's true. Right.
21st Mortgage, they're not. I don't know if they're the largest originator of chattel in the space or not. I'm not sure who is, but I'm sure they make a big dent in the chattel lending side.
But the other area on the multifamily side under the duty to serve is they want them to lend to more nonprofits from that standpoint, and also to resident-owned communities, which are basically co-ops. They've also come out with a program that. Well, Fannie Mae just put out a lender memo here a couple weeks ago where they're actually giving a price break for loans to manufactured housing community loans to nonprofits. And also, if you've got pad protection for the homeowners, pad protection leases, they'll also give a pricing break there. And it's kind of a sliding scale. So you've got 25% of leases have these certain conditions in, you can get a certain price break. And then it goes up from there. So they're really trying to push in those areas.
Are there any states where Fannie won't lend in the MHC space?
No.
Got it. Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. With regards to the types of communities, we talked about kind of their flavor for 3, 4, and 5 star, possibly consider a 2.5 star, with some type of capital improvement reserve in place and agreed upon plan of execution of what improvements are going to be made. Does Fannie get involved in any of the, what I like to call the hybrid types of parks, the ones that might have, tiny homes are trendy in certain parts of the country. And I've seen more and more, communities bring in that tiny home aspect, or, even communities that have maybe a full-time MH component with a part-time or seasonal RV component, which I like to classify as kind of hybrid parks. There might be a more formal name for them, but I call them hybrids because they've got the permanent, then they also have the seasonal basis. You see that a lot in Arizona, see a lot in Florida here, Texas markets, basically the snowbird markets. Does Fannie get involved in any of those types of loans?
Yes, they do. Their base underwriting guidelines allow for RV income. They prefer that the RVs kind of be located in one area of the park, but there's always exceptions. And you got to remember the agencies provide guidelines for lending, and you can get waivers for certain situations. But yeah, they'll allow RV income up to 25% of 10% of effective gross income.
Okay.
And talking with the guys over at Fannie Mae here recently, you can probably get a waiver up to 20%. And I think they're going to be coming out with new guidelines a little bit later this spring. And it's my understanding they're going to increase that to 20% of effective gross income. Now, at the same time, while I was at Fannie Mae, we did a couple of what I call age-restricted park model RV resorts. Mm-hmm. And park models are nothing more, you probably know this, that park models are nothing more than a little bit smaller home, but they're basically permanently placed versus an RV can be moved. And Fannie Mae considers park models the same as a standard manufactured housing home from the standpoint of their underwriting. But then RVs, they underwrite to the average of the prior 3 years. And then they restrict it to 10% of effective gross, or now 20% from that standpoint. So that's from that standpoint. But they'll look at a park model RV resort, probably needs to be age restricted on the high end quality side right now.
Okay. Fantastic. Let's talk about Greystone a little bit. Let's talk about, just maybe give a little bit of background of the company and kind of your involvement, from Greystone's perspective in the MHC space. I know you guys are involved in a litany of other commercial assets, but let's stick with the MHC and just get a better understanding of who Greystone is as a lender. Yeah,
Greystone is a Duff and Fannie Mae lender. They're basically a commercial real estate lending, investment, and an advisory company. They're headquartered in New York City. In 2018, Greystone had a great year. We did $10.3 billion of commercial loans across a variety of products, including FHA, Fannie Mae, Freddie Mac. They do bridge lending and they do CMBS. Mm-hmm. From that standpoint, the company was actually founded by Steven Rosenberg in 1988, and he remains the company's CEO. And the company is highly philanthropic. They donated they donate actually half of their annual profits to charity each year, believe it or not. It's amazing.
Wow. That is incredible.
Yeah, it's quite something. Yeah, it's an amazing company to work for.
Mm-hmm.
Greystone, this past year, Greystone was the number one HUD-insured multifamily and healthcare lender. Their total FHA origination volume was nearly $2 billion. From a Fannie Mae perspective, they were the number one producer of small loans. They were the number two producer of what they call green loans. Those are the loans where you come in with the energy efficient changes to the property.
Mm-hmm.
They were actually the number three producer of affordable housing loans, and they were number six as far as overall DUS lending. So they were in the top 10. For Freddie Mac, they were actually the number three producer of small balance loans and the number 10 overall Freddie Mac lender. So the company is really doing extremely well from that standpoint. And again, one of the pluses with Greystone is not all the DUS lenders participate in the small loan program. As you can imagine, the smaller loans, it takes a lot of back office, and to do a lot of volume, you got to do a lot of small loans from that standpoint. So you got to have the infrastructure to do it. And they're one of the DUS lenders that do small loan manufactured housing communities, which is a real plus. And now with this change to 6 million minimum, that program is going to really help them do even more.
How do the underwriting criteria, I guess, or how does the process differ once you go above that $6 million and get out of that small loan balance program? I mean, is it a much more restrictive and intrusive underwriting process or qualifying process, or?
Well, it's really not more intrusive. It's just that basically on the third party report side, you've got some efficiencies which save a lot of money from that standpoint. So your property condition report may or may not be required. And even if you have to do one, it can be a streamlined report versus a full report for a loan over 6 million. On the environmental side, you get a screening report. And if there are no issues, you're good to go versus having to do a phase one, et cetera. And there's no seismic requirements as long as you're out of I can't remember the exact, out of the major seismic areas. So there's some savings there that really help with the small loan side.
Got it. We haven't done any loans more than 6 million. That's why I ask.
Okay. From that standpoint. One thing, Kevin, let me just throw out one thing that I think is critical on manufactured housing communities, and it has to do with properties in flood zones. Fannie Mae and Freddie Mac will do properties in flood zones under certain situations. But here's the issue. So if you got the residents all owning their homes and there's a flood and those homes get wiped out, they may or may not have flood insurance. Now, of course, if they've got a lien on their home, they're probably going to be required to have flood insurance. But let's say you make a $5 million loan, the insurable collateral is probably only $200,000 or $300,000. So if you have a major flood and the community gets wiped out, from an insurance standpoint, there's a big shortfall. You got a $5 million loan and you can collect $200,000 or $300,000 proceeds, and the residents may or may not come back. Now, Fannie Mae has kind of looked into this, and it's really a case-by-case situation how they look at it. But in Florida, you've got a situation where, it rains real hard, the water comes up, and then it dissipates. It really doesn't destroy anything from that standpoint. But so as long as the living floor level of the home is above the base flood elevation, they will underwrite the income from that pad from that standpoint. But if you're next to moving water like a river or something that floods and can really be destructive, they're probably not going to be able to do the deal.
Got it.
Just
That's
because of that insurance. Yeah, you got such a big disconnect between the insurance and what your loan amount is.
No, that's good to know. I'm glad you brought that up, because that's surely something that's important to understand. I mean, there's a lot of deals that we pass on just due to the whether they're in a partial or full flood zone, but many deals we've looked at that are actually have portions of the park that are in floodways. That ultimately would be very destructive should rising water occur. It's good to know really what the options are as far as lending for those folks that are listening. So I appreciate you bringing that up, Jerry. Is there anything else that you feel would be relevant for our listeners to understand about whether it be Greystone or Fannie Mae in general before we work to wrap up the show?
No, as I mentioned, both agencies really love the product. It's performed extremely well for both of them, and it's full speed ahead from the standpoint of trying to do more and more business in that space.
Yeah. Well, fantastic. Well, I know that we've had a great experience with the Fannie loans that we've done, and I'm excited to see that chattel pilot program come out, because I think that would be revolutionary to our space. I mean, I feel that is one of the, as you know, that is one of the greater challenges. We've got many challenges in this industry. We've solved a bunch of them over the last 5 to 10 years, but we've got many more hurdles to kind of push through or jump over. And I feel like the chattel financing is one of those, at least as it pertains to, existing communities getting filled, right? Giving options to the end consumer or to the park owner to essentially bring new inventory into those homes and create internal sales programs. Chattel financing exists today, but it's incredibly expensive. It's cost prohibitive in a lot of situations, and it could be much better.
Yeah, it'll really open up to more people and make it more affordable for them to get into a home and get into a park. No question about it.
Yeah. Jerry, what's the best place to reach you? Greystone, just go to the website, or do you have is there another way for folks to find out more about Greystone and what you guys offer there?
Well, the website is a good start. I mean, I always tell people if they've got a question or whatever, they can always, contact me from that standpoint. I don't live in Atlanta anymore. I actually live in Superior, Colorado, which is just below Boulder, Colorado. We moved out here a couple of years ago from that standpoint, but I don't know if you want me to provide my phone number or...
No, I'd say, probably not a good idea unless you want to give it out. But otherwise, there'll be about 15,000 people that have your phone number. So I don't know if that's a good idea or not. But well,
okay,
yeah. So how about just guys, if you want more information, go to greyco.com. So it's Grey GREYCO.com. That's the website. And Jerry, can they track you down through the main company website or LinkedIn, or is there another avenue where they can reach out to you directly?
I have no problem providing my email address from the company standpoint. It's just Jerry, Jerry .Muir, MUIR at greyco.com.
All righty. Fantastic. Well, Jerry, thank you so much for joining us here today. It's been a lot of fun. I was very much looking forward to having you here, and just a wealth of knowledge, on the lending side of this industry. Again, you've been in it for a very long time. You've seen a lot of changes, lots of ups and downs. And again, I think we're on the right trajectory now. And I'm excited to see, what the future holds for Fannie and their lending programs. And the last 5, 10, 50, 20 years have all been evolution. That's all going in the right direction. So again, thank you for coming on and bringing your information on the show and your knowledge. And it's been a lot of fun.
Thank you, Kevin. It's been great. Thank you.
All right. You take care, Jerry.
Congratulations for taking the necessary steps to achieving massive success through the highly lucrative niche of mobile home park investing. Be sure to visit our website, mobilehomeparkacademy.com, to download your free digital ebook version of the 21 biggest mistakes investors make when buying their first mobile home park and how you can avoid them. And while you're there, be sure to subscribe to our free monthly mobile home park investing newsletter, which is jammed full of valuable tips, tricks, and strategies to help you accelerate your path to success as a mobile home park investor. More information about this podcast and its hosts can be found by visiting mobilehomeparkacademy.com.